Welcome back to Synaptic Dividends. We're always breaking down new dividend stocks to help you build out that passive income portfolio. So if that's what you're here for, definitely hit that subscribe button so you don't miss a thing.
All right, let's get right into it. Today, we're taking a look at GWW Grainger. Now, this is an industrial supply powerhouse, and it has a truly legendary dividend history. We're talking about a member of that super elite club, the Dividend Kings. But here's the thing, right? A fancy title from the past doesn't automatically mean your income is safe for the future. So the big question we're asking today is Grainger's reign secure? Let's dig into the numbers and find out. Okay, first things first. Before we get into anything else, we have to talk about safety. I mean, this is the absolute foundation of any good dividend stock. If the dividend isn't safe, honestly, nothing else really matters. So the question becomes, how much cash is actually left in the tank after all the bills are paid? How much is there to give back to us, the shareholders?
And to figure that out, we're going to look at my absolute favorite metric, the free cash flow payout ratio. Yeah, I know it sounds a little technical, but I promise it's super simple. Just think of it like your own personal budget. It's the percentage of your take-home pay that you have to spend on your mortgage or your rent. The lower that percentage is, the more cash you have left over, right? Well, it's the exact same idea for a company and its dividend. Lower is always safer. So check this out. You can see right here just how much breathing room Grainger usually has. For 2023 and 2024, the payout ratio is just incredible, 25% and 27%. Super, super low. Now, you're probably seeing that more recent TTM number, that's the trailing 12 months, and it's a bit higher, up at 47%. But even with that jump, it is still well within what I'd call a very safe range. It tells us that, even with some short-term changes, there's more than enough cash to cover that dividend, no problem. Let's just hang on that 27% number for a second, because this really shows you the margin of safety we're talking about. Think about it this way. For every single dollar of pure cash profit the company made in 2024, it only needed 27 cents to pay out its dividend. That means there were 73 cents left over for everything else, reinvesting, buying back shares, or just padding the bank account. That is a huge cushion.
Okay, so check one. The dividend is safe. That's a big green light. But, for a truly great passive income investment, we don't just want a safe dividend. We want one that grows over time. And to see if that's likely, we've got to look at the company's track record. History really does tell you a lot about a company's commitment to its shareholders. And Grainger's track record is, it's incredible. 53 straight years of increasing their dividend. Just let that sink in. To put that into perspective, once you cross that 50-year mark, you earn that coveted title of Dividend King. So Grainger isn't just in the club, they are a deeply established member of royalty here.
But, it's not just about how long the streak is. It's about the quality of that growth. And just look at these numbers. The growth rate has been fantastic and so consistent. Over the last 3 years, over 9% a year. The last 5, over 8%. Even going back a full decade, it's almost 7% annually. When you see that kind of consistency, it tells you that raising the dividend isn't an accident. It's a core part of their strategy year in and year out. So we've got a safe dividend and an amazing history of growth. But now for the ultimate stress test. What happens when the economy completely falls apart, right? How does the dividend hold up when things get really tough? Because the dividend that disappears when you need it most isn't much of a dividend at all. Honestly, this right here might be the most impressive part of the whole story. Let's look at the two biggest economic crises most of us have ever lived through. The 2008 financial crisis, and the 2020 pandemic. Grainger didn't just hold the line. They didn't just maintain their dividend. They actually increased it, both times. In 2008, in the middle of that absolute meltdown, they raised it by a staggering 17%. To be able to grow the dividend through two totally different kinds of disasters, that is the ultimate proof of a ridiculously resilient business.
All right, so let's pull all this together. We've looked at safety, we've looked at the growth history, and we've looked at its resilience. So what's the final verdict here? What are these numbers really telling us?
The bottom line is Grainger's dividend report card is just fantastic. It's safe with that super low 27% payout ratio. It's got proven, consistent growth with that 53-year Dividend King streak, and it is absolutely crisis tested, growing right through the chaos of '08 and 2020. I mean, the numbers really speak for themselves here.
Now, this whole breakdown was really focused on the key dividend numbers. But if you're wondering how they do it, what the business model looks like that makes these numbers possible, you should definitely check out our more in-depth analyses over on our main channel, Synaptic Investing. We go way deeper over there.
And of course, if this quick breakdown was helpful for you, hitting that like button really helps us out. And make sure you subscribe so you don't miss our next dividend analysis. Thanks so much for watching.